What's going on, guys? Welcome back to the channel. It's Ron Yates here. Hope you guys are doing very well today. For my OGs on the channel, I just want to go ahead and thank you guys in advance for always dropping a like for the videos. I totally appreciate that. And if you guys are new to the channel, please consider subscribing to that channel, to this channel. I would totally appreciate that. So I've been getting more and more questions about what am I doing to prepare financially, and how am I positioning myself with everything that's happening with the stock market, the economy, with layoffs, inflation, and with this real estate housing market, right? So there's a couple of things that have happened lately, right? So recently, there's this debt ceiling deal that that Congress has essentially reached an agreement on. And the United States has basically, without President Biden's signature so far, has essentially agreed to this new debt ceiling deal. So it's only a matter of hours, maybe a couple days before President Biden gets around to signing this thing. But this is pretty much going to be a done deal. And this would ultimately be confirmation of the agreement between Republicans and Democrats, allowing the United States to be able to move forward, be able to pay its debts, and to not default on outstanding debts and loans against the United States. This could very well have been the first time in history that the United States would have defaulted on its debts. And this would have been much worse than, me and you having a car loan and defaulting on the car loan and having the vehicle be repossessed. Much different than getting a couple months behind on your mortgage payment and having your home be foreclosed on. This would have had a much more widespread detrimental effect to the global economy. And of course, it would likely have ultimately destroyed all value of the United States dollar, the US dollar. So thankfully that didn't happen. But, we kind of expected that this would have been resolved beforehand. Now, obviously, there's some final details that need to be ironed out, but I'm pretty sure President Biden is going to sign off on this thing. That's my guess. Now, what's the impact on the stock market? Now, if you guys have been watching the stock market, the S&P 500 for a while, you've noticed that there's been some ups and downs. There's been this range that the stock market has been in, right? You got big companies like Microsoft, Google, Amazon, Netflix. They've been moving around in this range here lately. And basically, I think as an investor, I've been investing in the stock market for, 20 years, and just kind of looking at the patterns that have formed, it looked like the stock market and investors are kind of like, they're invested in the stock market, but they're kind of waiting to see what Congress is going to do with the debt ceiling, because you don't want to be in the stock market if Congress was going to let the debt ceiling just be breached and default on loans. The last thing you want to do is be holding on to certain types of assets, and U.S. Treasury bonds will probably be one of the types of assets you wouldn't want to hold on to. I don't see that happening, thankfully. So that's a very good thing for the United States and for America as we know it. So I kind of feel like we have created a nice base in the stock market. If you look at the S&P 500, look at the NASDAQ, you look at the Dow Jones, we've been pretty close to this near all-time high range for several months. And we had some pullback, but for a long time, we were within 5 or 6 percentage points of the all-time high. So all we need was some certainty, or at least a little bit of direction in terms of where we might be going. And if you guys have been, investing in the stock market for a while, leveraging your favorite platforms like M1 Finance, E-Trade, Fidelity, Moomoo, Webull, you would know that the stock market does not perform well, or at least not to the positive side when there's a whole lot of uncertainty into the market, right? So I think that we are pretty poised to be able to see a market rally, a stock market rally, once we get confirmation that this debt deal is going to be signed off, put it behind us, and at least we won't have to worry about it for several more quarters, because this is basically the can getting kicked down the road, and we're gonna hit this area again. But if we could at least get this part behind us, I think we'll be in some pretty good shape. Now, Obviously, there was, the stock market had a holiday last week, and the stock market was closed, and that kind of allowed investors to regroup and really think about what they want to do with their money at that point. I think it's also interesting to see how the stock market behaves the day before holiday weekend. Historically, when you see a big sell off before a holiday weekend, that's usually not a good sign. But we didn't see that. In fact, we actually saw some positive gains in the stock market leading into the holiday weekend, which was good. So I think going forward, we're probably going to be in a pretty good position. The next thing to concern ourselves with that we need to keep an eye on is what the Fed's going to be doing next. Fed Chair Jerome Powell will be making announcements in terms of what they're going to be doing for the next interest rate hike or interest rate cut or just interest rate pause. They really only have three options. And so what the Fed is forced to do or decides to do during this next meeting is going to have a lot to do with the direction of the stock market. So that's going to be really interesting. We'll definitely want to keep an eye out on that one. I don't feel like now is a time to start cutting interest rates. I talked to a number of different real estate agents here in the Florida area, and they're kind of expecting that the housing market is actually going to continue to soften. That's what we're hearing from a number of different agents in Florida. In Georgia, I was hearing similar things, but in Texas, I got a different sentiment. Let me know what you guys are hearing in your areas. But, me personally, I'm going to continue investing in dollar cost averaging into my favorite companies. Definitely going to continue to dollar cost average into my Vanguard VOO ETFs and index funds, all of the solid companies. See, when I buy companies, guys, and when I buy ETFs and index funds, I'm buying these companies and index funds for the long term. I'm not letting these short-term hiccups impact my own decisions. Now, maybe some opportunities open up where I want to kind of like double down on certain types of assets, depending upon the types of opportunities that open up. But for the most part, I'm not getting shaken out of the market because of a decision here or there, or because of, unexpected things happening in the economy that are likely only going to be short term. I'm buying companies kind of like Warren Buffett. I'm buying companies that I'm good with holding for the next 20 to 30 years. So that's my strategy. And I also like to invest and purchase companies on the within the S&P 500 mainly that are paying dividends. That way, as stock prices go down, I'm able to purchase more stocks at a lower price. And as the dividends continue to pay me, those dividends are buying me more and more stocks that will increase how much income that I'm able to generate passively from the dividend income payment. So that's where I stand. But I think that we really need to be careful against, some of these excessive interest rate increases to avoid a recession. And I think the Federal Reserve knows that. If we go into a recession, all bets are off. But at the same time, my strategy remains unchanged. So if we can avoid a recession, that would be great. And if we can come out of this thing and actually see our economy really, really pick up and start seeing people going back out to the stores, going to the malls, start shopping again and increase that consumer confidence, hopefully, hopefully Americans can actually increase their income, pay down some debt, stop running up these credit cards. They can actually build some wealth for themselves, but also have a more sustainable track for the future of the economy. So I think in the long term, that's good for everyone. If Americans can actually make purchases without having to rely on their credit cards, this is more sustainable, because if Americans have to use their credit cards to make the purchases, we all know where that's going to go. And so that would ultimately lead to credit card default, car repossessions, real estate foreclosures. It's just a negative direction that will go. But if we can actually get some real GDP growth through the creation of wealth, through actual income being earned and that money being spent without having to go into debt, I think that's going to be really, really good for the stock market long term and for wealth building. So I think the next thing we really need to just kind of pay attention to is what is the Federal Reserve going to be doing in terms of whether they're going to be cutting short-term interest rates by the end of the year. Are they going to hold on short-term interest rates?